Hello, everyone. Welcome to this live session. If you're just joining in, please do very well to leave a comment in the comment section, letting us know um, where you're joining from. If you're watching this live from, this is simply a live session, live training on FX, which is Forex Trading. It is an introductory class to basically understand the whole concept of Forex session. If you're just joining. Um, Just let me know in the comment section if you're just joining and if you can hear me very clearly and you can see my screen very clearly. Like I said earlier on, I'm just going to go on to just start the training fully. So if you can remotely see what I'm doing, please let me know in the comment section. I can't seem to see anyone commenting. Is there some technical? All right. I can see your comment. Please let me know if you can hear me very clearly. If I'm very audible, let me know in the comment section. So I'm using my device here to kind of figure out who is trending and the comment and all. I'm gonna wait. If I get one person say I'm very clear and he or she can hear me very clearly, we'll just go on and start. All right. So please, I would appreciate for you to do that for me. All right. Awesome. All right, guys. Welcome on board. We're just gonna go on and start. All right. So today we're starting basically on the basics of forex trading and what forex trading represents, um, and everything that you need to know. Now, my sole aim is that by the end of this class, not my sole aim. Yes, that's my sole aim. However, that is also like what is expected because the truth is, like I said in the previous class, um forex trading is literally it's the same today, tomorrow, and forever. All right, there are only some few distortions to the market every now and then, but that's about it. But if you know something about forex trading rules, it's just that people apply it differently, and by the time you're done learning, your application of the knowledge will be different from my application of the knowledge. Do you understand? So everybody would apply the knowledge as it suits him or her. Everybody's going to apply the knowledge as it suits. So it's like saying that I like to take my water from a glass cup. Another person would prefer to take his or her water from the bottle. Another person would want to prefer to use a plastic cup to take the water. Some people would prefer sachet water, but regardless, we are taking water, right? So the most important thing is that we are hydrating our body. So by the end of this class, you will know almost everything I know about forex trading, and expectation that the difference between myself and you by the end of this class will simply be experience. That's all. All right. The difference between myself and you is just going to be experience, and even as the concept of experience is concerned, as you keep doing it every day, you keep getting better. All right. So, like I said, I would appreciate it that you have your pen and your paper. This class is only going to last for 30 minutes. I'm not going to spend too much time today on the live session. Like I said, for people who are serious, I'm just going to start up straight. I think I will spend close to 5 minutes just. Um, right. So, like I explained already what the forex market represents and everything that the forex market is and everything that I think that you need to know. All right. Everything I feel you should know about the forex market. It is my belief that I explained that in the previous class. So we're just going to go on to deal with what really is important to you right now. Now there are three basic things about forex. three basic principles about forex, or rather established fact, which is, um, or rather, there is one principal thing about forex, which is the fact that you need to analyze it. All right. It is important that you analyze the market. Everything you do, there need to be a form of analysis. All right. So now in forex, there are three types of analysis. One is the technical analysis. Some people just use it as TC. So you read certain books, you just see it as TA or TC, right? Like I said, please, if you have your book, please write this down if you do not know it already. All right. There's technical analysis, which we will be focusing more on, and then there is the fundamental analysis, right? FA, and then there is the sentimental analysis, right? So the technical analysis, fundamental analysis, and sentimental analysis. Now, technical analysis is simply a reflection of we simply get to analyze the market using certain patterns that have been repeated over time. And these patterns are represented in different forms, candlesticks, market structure. That's where you hear things like the Fibonacci, the market structure, the fair value gaps, the volume imbalance. All of those little key words I just mentioned now are kind of the intricate part of um, technical analysis. So it's just using certain technical analysis basically is just using certain repeated patterns to actually predict, because it's all about prediction, to predict where the market is going to head or where the market is coming from, what the market is saying per time. Now that's about technical analysis. That is what we will be focusing fully on, and in the closing stages of this class, I'm talking about the overall class. I would now get to talk to you teach you about fundamental analysis and, of course, sentimental analysis, which are very critical. A lot of people will teach forex, and they will just teach you the technical analysis part. However, it is not all that there is to forex. There is the fundam. It is very important, the fundamental analysis, because you can be done with your technical analysis, but because you ignore the fundamental analysis, you lose ridiculous amount of money because everything will be going against you. All right. So that is that about technical analysis, and then fundamental analysis simply speaks about the general occurrence in the financial world, right? For instance, the global happenings around us. For instance, the Russia-Ukraine war that is ongoing. When the Russia-Ukraine war initially, happened and all that, or started, that is going to significantly affect the market direction. However, some traders ignore fundamental analysis. Now I'm talking about fundamental analysis. Some traders ignore fundamental analysis, thinking that they can just trust their technical analysis, candlestick pattern, how the candlestick work, how it fluctuates, its movement per time, and all that stuff. All right, which is all right. However, you cannot ignore things like the fundamental analysis, which are global occurrences that directly or indirectly trigger the financial market. For instance, the 9/11 event, which was the when the Osama bin Laden event. Am I supposed to say that on YouTube? Okay, I think there's a rule about mentioning that. But the event that happened, where there was some plane running into, um, how that event happened. That significantly affected the financial market, the US dollars. And when it comes to forex trading, you're simply trading one currency against another currency, or one stock against a currency, or whatever. You're sure trading something against something, all right? And in the global setup of the financial market, it will be unwise of anybody to just focus on the technical part and not really also take into cognizance the fundamentals, right? And then the third one is the sentimental analysis. Sentimental analysis is simply talking about how traders react to the market. And this is not talking about it. Some people will tell you it means how a trader, talking about yourself, react to the market, which is true. but it is also strongly about how traders globally react to the market. And we're going to see that as the class progresses. Now, we're going to be focusing on technical analysis, and that is going to take like 2, 3, 4 classes. But I'm going to be using this material from Wade FX, his setups and all that, talking about the forex market and the price actions and all. So we're going to be using his this material for the sake of this class. All right. Now the things that we will be covering in this class, and all of this is always would revolve around fundamental technical analysis, the basics, literally the basics, and then we'll focus on market structure. We will also look at liquidity, other blocks, daily range price actions, full setups, putting everything together at the end of the day, and then using them as individual conferences to make decisions in the market. Now, I am not expecting that everything I'm saying will make sense to you right now. Do not expect it to make sense to you, because it didn't make sense to me too at first, right? But eventually, when you understand the different part and the different section one after the other, it will all come together and make sense to you. Then you will be the one to be the basics. We're going to be starting with expansion and retracement. Now, expansion and retracement is in the market, simply focusing on movements in the market, right? The for instance, the high, if we're talking about expansion and retracement in terms of the US dollar, that would be one time it was at 1,800 naira, talking about the currency per naira against the dollar, right? At some point um it was 1,800 naira to $1, right? That would be an expansion, and currently it's about 1,400 naira, right? That is a retracement. It means that it moved up and came down. All right. So I would be trying to, as much as I can, to simplify these terms for you. But then again, don't overcomplicate it. Don't see it as, oh, this is some ridiculous. Forex is simple. You just have to simplify it for yourself. All right. So expansion occurs when there is an impulse movement towards a direction, and retracement is the correction movement after an impulse movement, right? So using the US dollar as an example, expansion simply means expansion would be when dollar went to 1,800 naira, and retracement will be right now that it's at 1,400 naira. All right, so expansion and retracement. But again, the concept of expansion and retracement is relative to the direction of the market. For instance, if your focus is the uptrend, let me just use this as so when we're talking about uptrend, the movement of market in moving markets in the up direction, which we call usually the buy arrow that heads up, and retracement is this arrow facing, that means moving up, expansion, coming downward, retracement, moving up, expansion, coming down, retracement. I'm sure you must have seen this in candle patterns. This is a practical representation of expansion and retracement. All right. So this is more like a movement. This is an expansion movement in the upward direction. Retracement, the two red candles coming downward direction. Expansion is this moving up again. Retracement, the red candles, expansion, retracement, expansion, retracement, expansion, retracement, expansion, retracement. All right. So this is basically what expansion and retracement simply means, but in the up direction. All right. Like I said, the concept of expansion and retracement is relative to what direction you're focusing on. So if you're focusing on the downtrend of the market, um, this is expansion. Expansion is the coming down, and the retracement, which is the correction, is moving back up. Expansion coming down, retracement moving back up. Expansion coming down, retracement will be moving upward, because it's trend. Because with the uptrend, it's when you are actually predicting that the market is going to move in the upward direction. I'm using up. That means the market is going to buy. That's what we call it, right? Practically, right? So if you are predicting that the market is going to buy, your expansion is when there is a movement upward, and your retracement is when there is a movement downward. But if you're predicting that the market is going to sell, which is there is going to be a to the downside in the market, that is your prediction, and that is what you're focusing on. Your expansion will be when there is this movement to the downside, and your retracement will be when there is this movement to the upside. All right. So I don't want to spend too much time on that. Like I said, I needed everybody to be here on the live so you can ask your question. So this is a practical representation of that. A practical representation of, you know, expansion and retracement. This you can see here. We have E, expansion moving upward, retracement coming downward. You know, expansion moving upward, retracement coming downward, expansion up, retracement down, expansion. You know, it's just literally, this is just showing us a practical representation of that. You can see this movement, this long movement up to the upside is an expansion. The market buying to the downside is a retracement. The market moving to the upside is an expansion, and it's a retracement. All right. Now, you just need to know this technical jargons. You need to find it, but don't worry about trying to know all of it at once. The more you use them, the more it sinks in. Like I said, please, if you're just joining or if you're still here, let me know you're here so I'll be sure I'm not talking to myself. All right. So we're going to move to the next thing, which is the Fibonacci retracement. Now, this reads that, sorry about that. The Fibonacci retracement. Now, this is used to determine the end of the retraction movement. Usually, the price retracts to 50% or until trade equity. Now, open trade equity is simply talking about when you open a trade, the particular point where a trade is at any time is the open trade equity, or how your equity, literally what your capital is. Now, this 0.62 here is talking about 0.6%. Now, you understand very well that in mathematics, you multiply 0.62 by 100 is going to give you 0.6. It's going to give you 62, which means 62%. And this is 0.7. So just see this as, 60%, 70%, and 80% when you round this up. All right. Now, Fibonacci retracement is simply one of the tools. It's called a confluence. One of the predict that the retracement in the market, right, of about 50%, sometimes 60 to 70, we are sure, or to a large extent, we are sure that the market is going to now move in the opposite direction. All right. Let me explain this to you in practical terms. I think that's the best way I will be able to do that, to explain it in practice. So I just stopped sharing my screen so you can see me face on, and then I can explain. I can use my pen and my paper to explain to you. Now, I'm explaining to you the Fibonacci retracement. Now, I already explained to you that in an uptrend, this. Oh, okay. Let me put it this way. This is an expansion. This is a retracement, right? How do I hold my pen? This is an expansion. This is a retracement. This is an expansion. This is a retracement. All right. That is in an uptrend. And then when it's a downtrend, when you're predicting that the market is going to go down, right? You're predicting that the market should come to the downside. It's literally the opposite. What was your retracement becomes your expansion. What was your expansion would now be your retracement. Now, in a Fibonacci, what a Fibonacci simply means, is that we are predicting that when a market has moved to this point, there is every tendency that it is going to come back to a 50% position, which is somewhere around this region, right? Before it moves back up again. There is always every tendency that it's going to move to somewhere around a 50% position before there will be another movement in the upward direction. That is if you're talking about an uptrend. All right. We're talking about an uptrend right now. So the Fibonacci retracement is simply a strategy, is simply a tool. Now, this Fibonacci, I don't want to bore you with too much too much jargon, but let me just show you practically using a trade to explain that to you. Okay, so once the screen I'm sharing comes up on my other mobile device that I'm using to also stream, then I'll start. I'm trying to share my screen with you so that I'll show you this clearly, easily. This clearly, easily. Why it's not showing, but let me just continue showing from the other device I was using. Clearly, easily. Why it's not showing, but let me just continue showing from the other device. This sorry, I'm trying to share my with you because I mean there will be no point just talking if you're not seeing my screen. So I'm also streaming on my phones to see if you guys can see what I'm doing. So basically the Fibonacci retracement is simply trying to say that for every movement of market, for every expansion of the market in whichever direction, chances are that the market is going to make a return of about 50% before it continues in that direction, right? It's going to be a retracement, it's going to come to the opposite direction um, at about 50% before it finally makes its final movement initially. I'm not sure why my screen is not showing yet. For what it's worth, this is frustrating. Finally, please, if you can hear me and you can see my screen, let me know. I can see there are only 3 people on this live, but I mean, if I only have one person here, I'll still be doing what I'm doing. All right. So the fib retracement, like I said earlier, I was trying to show you a practical chart, but I don't know why YouTube is not letting me show that. The Fibonacci retracement, like I said, it's used to determine the end of the retracement movement. Usually, the price retracts to 50% or until 70, 60, 70 before another impulse movement. All right. Now, um, the Fibonacci retracement in practical terms, this is how it will look in a chart. All right. This is how. All right. Thank you so much. Thank you, Barry. Thank you, Kachi-san. Thank you, Nanich. This is how a Fibonacci retracement is going to look like in a practical chart. Fibonacci retracement, right? Now, this is a movement to the upside, and then this is a retracement. Now, let me zoom this in for clearer context. Now, what the Fibonacci retracement is talking about is that when there is a move, if you want to test what the Fibonacci retracement is, you take it's a tool I'll teach you how to use the tool. All right, eventually I'll teach you how to use the tool. So you take your Fibonacci, all right, it's literally usually on it will be I'll be showing you how to use trading view because trading view is literally simple and easy to use, right? And then you will drag it across your chart. However, you're going to be dragging it from the recent upward, the highest upward movement of a particular trend. For instance, this upward movement, this is a downtrend. Remember, I taught you uptrend and downtrend. Now, this is an uptrend. This is a downtrend rather. Now, when you want to get the Fibonacci retracement or the expansion and the retracement in terms of Fibonacci, you measure from the highest red candle to the lowest red candle. I'll say that again. You measure from the highest red candle to the lowest red candle, which was what was done here. Now you take 50% of that movement. This is the 50% of that movement. Now, what the Fibonacci retracement is saying is that for every movement, when you measure the highest upward move, the highest movement, the highest candle in the movement and the lowest candle in the movement, if 50% of that movement, chances are that when the market is going to retrace to that point, And when it does retrace to that point, it is going to continue in the previous movement it was in. All right. So you can see clearly here that the market was coming down, right? And then we measured from the highest red candle to the lowest red candle. And when when it got to the 50%, then it retraced, right? Then when it got to the 50%, here this is the 50%, it moves slightly above the 50. Now, of course, you know very well there is a concept of stop loss. So when you're buying, when you're actually entering any trade on Forex, you're not entering the trade just as at where you are entering the trade. After entering the trade, you need to put a stop loss. All right. Now, stop loss is going to be a little bit above where what you bought from. So if I'm predicting that the market, for instance, if I'm predicting that the market is going to go down, right, and I bought at $5, right, I am going to be putting my stop loss. I'm predicting that the market is going to be going down, which means that the market is not going to, it's not going to be 5, 6, 7, right? That's not my prediction. I am predicting that it's going to be 5, 4, 3, 2, 1. If I buy at a position of $5, right? I'm using that as an example, right? If I buy at $5, my stop loss is going to be somewhere around $6 or $7, right? Now, what that means is that I just measured that however big your portfolio, money you're using to the market, right? What you're saying is that I can afford to lose this percentage of my money in order to make this other percentage. So you can say that okay, I'm risking 10% of my entire money, of my entire asset to actually make a profit of 50%. That's what stop loss simply means. All right. When some people are teaching you forex trading and all that, they would use some of these languages. Probably break that. There will be a list of all the terms, stop loss, this. So I would rather just teach you and be using the words. The more we use it, by the time we are done with this class, you would be using the words too, so you'll be used to them. All right. You can see the market came back to 50% region, right? So for anybody who bought here, it went on, moved past the 50% to about 60%. So normally a wise trader would put his, he will not, a wise trader would put his stop loss somewhere around the 60% or 65% thereabout, right? So that when the market, because the market is not a respecter of anybody, the market is not for you. So it's not just going to come to the 50%, just you enter the market at 50%, and then it will just start moving in your direction. In fact, if there is anything, the market in itself actually wants you to lose money, because the only way the market actually is when you lose money, right? So you have to be smart. Like I said in my previous class, if you've not watched that, please try and watch it. I said that what we're trying to do is we're just trading against big players in the industry, big financial market players in the industry. All right. So basically that is that about stop loss. So here we come to the 50%, the market moves slightly upward, and it continues moving in the downtrend. All right, it continued moving in the downtrend. Now this singular retreat, this singular expansion, remember, if it's a downtrend, this E here means an expansion in the downtrend. An expansion in the downtrend. Expansion simply means it's going in the direction you want. Retracement, it is going against the direction you want. Simple. Now, this long expansion, which is a second, you can see that there is another what's it called now? There is another 50%, which is a Fibonacci application here. There was another application of the Fibonacci rule here. So what they did was they measured the highest red candle here. I'm actually using my cursor. You can't see my cursor. Oh, cursor now, right? I'm just going to wait. Nicola says, please, can you use your cursor for demonstration? So it's also showing. Don't worry, after this class, we might just find an alternative way we can actually do this so that it will be easier to communicate. Excuse me. I might just have to use we might just have to use the Telegram platform directly. There's a live session on Telegram. All right, guys. So sorry, please, I might not be able to do that right now, but maybe in the next class. So you can see there is another movement here. I highlighted this so that it will be clear. Now, from this point, there is an arrow. From this place where there is an arrow here, let me move it from the left side of your screen where there is an arrow facing downward, right? That is the highest. That is the highest. What's it called? The highest red candle in the downtrend, right? And then you can see the arrow, right? There is a movement to the downside, right? So they took another measurement, right? From the highest red candle to the lowest red candle, now measuring the 50% of it. You can see what the market did again. This second arrow here, this very second arrow, I'm trying to use words. This second arrow, there's one arrow at the top, the highest arrow, then there's one arrow in the middle. It's the 50% retracement. But again, you can see by the right hand side of this chart, you can see numbers. You can see 0.5, 0.62, you can see 0.705. These are all talking about percentage, right? 0.5 means 50%. You can see what the market did. It got to the 50% and then moved slightly higher than the 50%, all right, and then moved again in the lower direction. All right. So if a market does this, what we say is that the market actually respected the Fibonacci retracement principle. Now, again, I don't have the time to actually go into detail and explain to you the Fibonacci, whatever. It's a rule in he's a person actually. All right. So I don't have all the time to explain to you all of that stuff right now because we're trying to rush. All right. So that is that about the Fibonacci retracement in the in a downward trend. And when you do the same in the upward trend, all you have to do is to reverse it. All right. All you have to do is to just reverse it. We just did a downtrend. So if you want to understand it in the uptrend, just reverse it, right? So that will mean that moving up is your expansion, retracement is coming down, all right? If you're taking the uptrend into consideration. So the next thing we want to focus on is BMS, which is break in market structure. Now, a break in market structure occurs, or let me hold on so that it probably shows on your screen before we go on. I said we are going to spend just 30 minutes. It's already 36 minutes, but that's still fine. Now, a break in market structure occurs when the price closes above or below a swing high or low. Generally, every trader should trade in the direction of the higher time frame break in market structure. Note, after break in market structure, always wait for retracement. After every break in market structure, always wait for retracement. Remember the 50% retracement I told you about. Now, a break in market structure, as I said, I want you to take my words. I want you, all this grammar you are hearing here, break in market structure, just use it, take it in their literal term. Break, market, structure, break, mark. If you are a Nigerian or whatever, use pidgin English to make it make sense to you. Break, a break market structure. This is market structure, right? For instance, this is a market structure. A break a market structure. Do you understand what I'm trying to say? So this is a market structure, right? This cord I'm holding is a market structure. So simply in literal definition, break simply means to break the structure. This is the structure of the market, right? And then something alters it and is broken to either the upside or the downside. That's literally what breaking market structure means. So what that simply means is like it's the definition. It occurs when the prices closes above or below a swing high or low, which means that when a market, that's where the idea of previous day high, previous day low comes in. When a market has traded within a particular zone for a while, and then the market eventually just breaks that structure, breaks that zone, and moves in the upward direction or moves in the downward direction, we say that that market that will say that there is a break in market structure. Now, it says here that the note here is that after every break in market structure, always wait for retracement. So when there is a break, excuse me, when there is a break in market structure, right, the wise thing to do is to wait, because there would always be a retracement. It never stays up there. Every time there is a break in market structure, which means that there is a particular trend movement, all right, either in the lower direction or in the up, in either an uptrend or a downtrend, and then suddenly the market breaks that structure and moves way lower than that zone. There is a break in market structure. What is advisable is for you to do not place a trade in that region. You wait for there to be a retracement, because there would always be a retracement. Like I would always say, the forex trading market is the same today, for today, tomorrow, and for yesterday, today, and forever. It's just for you to be smart enough to understand these repeated patterns and how to take advantage of the repeated pattern. All right. So that is what a break in market structure represents. Now, this is an example of a break in market structure. Now, there is a BMS here. Now, in the original movement of market, I don't know how to explain this to you, because you said you can't see my cursor. But I'm going to share this. I'm going to share this material on the group. So wherever we get to, you can just go and read it up. If you don't understand, in the next class, we'll probably do a Telegram live or a Zoom meeting. That would be better, because I'm not understanding this YouTube live. All right. So if you can see here, there is a break in market structure here. Wherever you see a BMS, it's called break in market structure, which means the market is moving. You can see that it's a singular candlestick that is actually breaking that trend. It's not some multiple, it's a singular candlestick that breaks the movement of the market and moves in itself. It moves in a direction that is contrary to where the market is actually headed. I don't know if that makes sense to you. For instance, this is a market that is supposed to come down, and then there is a break in market structure. It moves like, it's in literal term how they go sending. That's literally in pidgin English. They go where market say a candlestick, they go where the no send them. That's what a break in market structure means. So the market is moving in a particular direction, and then there is just a break. There is just some movement that is right. Now the next thing we want about is range high and range low. But again, I already said that we're going to spend 30 minutes in this class today. So I'm just going to stop at this point. I don't want to confuse you. So I'll drop the material on the group, so you guys can just go on and study it to where we stop. We stopped at break in market structure, which is BMS. So please study it to that point. Do not confuse yourself. If you can read further, fine, read further. But again, I would advise, do not confuse yourself, because this can be very complicating. All right. So guys, thank you for coming. I am exhausted. Sorry, I moved the meeting to a further time. I'm literally exhausted. All right. So thank you for your time. I would for the sake of clarity, I would come up. I would try to think about a better way we can actually um I'll try to find a better way we can actually do this so that we can communicate better. Someone, Nicola says, can one have sort of this copy of Forex Trading? Tell us what to do to get it. Don't worry, I'll give it to you for free. I told you guys, everything I'm doing is for in this class. The only time I will charge you is you would actually pay a fee if you're trying to join my private class, and if you know very well. When was have I ever? I can't remember the last time I actually said, "Oh, I only tell you if you come to my DM to talk about a private class. I'll never like publicly come and meet you and say, "Oh, come and join my private class," so, because it's not a do or die affair. So for people who are in my private class, you just pay what is expected. What you even pay is not even half the value you get, the one-on-one mentorship. But again, that's not for this class. So just focus on what I'm teaching you. I think if you're able to follow this carefully, this might be more than enough. Just that it might not be as fast as you want it, because it's going to be it's going to be in my according to my terms, or my time. When I'm free, I'll teach. When I'm not, I will try to tell you, oh, let's move the class 1 more hour, one more day. All right. So, guys, thank you very much for coming. It's interesting to see that it is just now that the class is coming to an end that a lot of people are joining. All right, guys, I'll drop this on the platform, and do very well to study to where we got to, which is BMS, and then we'll take it up from there. All right. Thank you so much for joining. Do have a lovely evening. Bye bye.